And so we're so happy to have some amazing people on the panel today. You're going to love what you're learning. It's going to help you so much in your business as real estate agents, and also for our loan officers out there. I want to welcome all the realtors. And number two, I want to thank you for all of the support that you give to your Fairway loan officers. We know without you, we don't have anything. And so we're just beyond grateful for realtors. Our prayers, we're still in the essential space. Many of you are not right now, and our prayers are all over you people that this we all get freed up to go back into our offices and back out into the street selling homes. And so we're rooting for you. So thank you guys for joining today. I do want to turn it over to, we call her Da Mansion. She has a really large office at corporate. We kind of laugh about it because you could go live in there for about 3 years. She is our head of servicing. She has a very, very, very long history in servicing, and she's incredible. So Kim, why don't you introduce yourself? Just give a little bit of history so the agents understand how much you know about servicing.
Okay, well, I'm going to have to date myself a little bit, and
Me too.
Home kitchen right now. So I've been in the business for over 30 years. I've been the servicing manager for MetLife, for First Tennessee, First Horizon Home Loans. Started out my career with CTX Mortgage Company a long, long time ago. So I've got an accounting background, a finance background, and a servicing background. And I've got two teammates here with me on the phone today. And it's Angela Kavner, and she is responsible for our controls and our communications and our subservicer oversight. And we've got Dewana Richard, who is responsible for all things loss mitigation and all things default. And they both bring lots of years of experience as well. So we've got a great servicing team, and hopefully we're providing some great service to our customers during this very traumatic time. So we did prepare to walk you through what we call a waterfall, because we want to explain to you what customers that are impacted by COVID-19, what they're going through, and the kind of information that they'll get when they contact their—
Kim, before you start on the waterfall, what is a waterfall? Where did that come from through the being of forbearance?
So I would think of it as a hierarchy. So it's like you start at the top, and then you have solutions and choices that will be made available to customers. So it kind of falls like a waterfall.
Okay.
So think of it as a hierarchy. And Ray, if you wouldn't mind, if you could put that chart up, we can show you. We've tried to display like a waterfall, and hopefully we can point that out to you. And I know this is really busy and maybe kind of scary, but we're going to walk you through this very quickly.
And Kim, where did forbearance, who came out with forbearance? So maybe just go back to the very basic on the why forbearance.
So forbearance is not new. Forbearance has been around for a long time. Forbearances were used largely throughout the Great Recession, 2008 through about 2013. Forbearances are primarily utilized for disasters because they're used to remedy a temporary hardship, a temporary situation. And pretty much, at least when this was initially rolled out, you know, with Fannie's response, Freddie's response, Ginnie Mae's response, HUD response, all the responses is they're treating this initially pretty much like a temporary hardship. So the first box there on this chart that's displayed for you, it tells you what a forbearance is, or a forbearance plan. Most customers right now, if they call their servicer, they're going to be offered to be put on a 90-day forbearance plan. This basically means we're trying to give you time. We're trying to get you to pass this situation. So during that 90 days, you don't have to make a payment. You can make a payment. It benefits you to make a payment. But at the end of that 90-day period, hopefully the hardship has gone away and you're able to resume making payments. So during that 90-day period, the main thing I want people to understand is it's not payment forgiveness. Let's take an example and say the customer's payment is $1,000 a month. During that 90-day period, they don't have to make a payment. But at the end of that 90-day payment, they now owe us 3 payments or $3,000. Okay, that doesn't go away. Now, during that time frame, they'll be If they were current when they went into this forbearance, there will be no negative credit bureau reporting and no late fees charged to their account. So, and during that time, during that 90-day period, your servicer will have contact with that customer to kind of get updates on what's going on with their financial status and to prepare them for next steps or next actions at the end of that 90-day period. Now, if COVID-19 is still lurking out there and it's not resolved at the end of the 90 days, most servicers and investors will allow that we extend that forbearance period. They could be extended for another 90 days. And the CARES Act actually allows, as necessary, that it could be extended another 180 days after that. But keep in mind, if that gets extended to a 6-month forbearance or even a 12-month forbearance, at the end of that period, they owe $6,000 or 6 months worth of payments or $12,000 or 12 months of payments. So does that help, Sarah, to explain to the group kind of what a forbearance plan is? Think of it as, I'm just buying time. But I do still owe those payments.
Yeah, I love what you just said, that you're just buying time. And everybody needs to understand that. Realtors, if you're out there, again, and I know Kim and Angela and Dewana, you're going to get into this, but where agents, you really, really, really need to pay attention is what's happening. Again, this is nationally with all mortgage bankers and all banks, is the starting of the positions they're starting to take if someone is in forbearance. And so I know, Kim, you're going to get into that. You guys are going to discuss that, because one of the things that you will see agents coming from your loan officer, and here's the beautiful thing about Fairway, we are continually educating our loan officers. We're getting them out in front to make sure they have all this information. There's so many companies that are not even talking about this stuff. And so people are getting burned trying to get their folks to closing, because this stuff is now starting to kick in regarding the impact of forbearance. So I love what you said, Kim. Forbearance is not forgiveness. It's just buying time. That's all. So back to you.
Okay, so the next step, let's say they had a 90-day forbearance. At the 90 days up, they owe us $3,000. So what's next? So this is kind of where the waterfall goes in. You'll kind of see we've kind of got a slant with the arrows going down. And these are not choices. These are the order that the options would be presented to the customer. And once they qualify, that's the option that will be offered to them as they move into more traditional loss mitigation. So the first option is a full reinstatement. That means they were able to save that $1,000 a month, and the 90 days is up. We're all out of this. We're all going back to work. Business is back to usual. They pay us $3,000. No harm, no foul. There's no delinquency showing on their account. They're good. They're reinstated, paid in full, and they're done. But let's say that they don't have the $3,000. They used it for living expenses. They used it to help other family members. They do not have $3,000, but they did get their job back. They're working again. They can make $1,000, and maybe they're even making more money. They may be able to get a repayment plan if they can make more than their current payment. So if they could agree to making $1,250 a month or $1,500 a month, whatever that amount is, typically repayment plans will be for the next 12 months. And the idea here is for the next 12 months, you're going to continue to make your monthly payment and contribute toward those payments that you missed for those 3 months.
So Kim, we got a bunch of questions. So I'm gonna jump.
Okay.
Here's one from Barbara Belknap. Hi, Barbara. Barbara wants to know what happens. So she's got a seller that is going into forbearance and their house sells. Can they take the proceeds from the home when it sells and settle at closing what's owed on the forbearance?
When so the house that they've got the loan on, they're going to sell their house. So Absolutely. When we get a payoff quote, their payoff quote is going to reflect the last paid installment, and all those will be due at the time of payoff.
Okay, so we're going to continue on with that story. So they sell their house, they pay off the forbearance, they're going to go into a loan or hope to go into a loan. How is that forbearance going to be looked at by the lender into the new property trying to get that loan?
So I'm going to turn that over to Angela Kavner, but I would tell you for the most part, that's kind of a big unknown right now. There are no guarantees as how this is going to show up on people's credit going forward when we get past all of this. But Angela can get into some more details on that.
And I'll just add, this came hot off the press last night from one of the biggest warehouse lenders, which was Chase Bank. Chase did put into their verbiage last night that they will not buy a loan off the warehouse line if they've been in forbearance. That may change. Everything is moving so fast, but that was last night around 11 o'clock.
Right. That's what's really difficult about the whole situation, because we've always had disasters and we've always had forbearance plans for those disasters. But most disasters are regional. They're not global. They don't affect the whole world, and for us, the United States. So a lot of the answers we need are still pending because the government has to come up with those answers. Regulators, the GSEs, HUD, they need to come up with those answers because, you know, this is very hard on the mortgage environment in general, the forbearance, if we can't sell loans and we need to retain them. You know, it's...
So Angela, tell everybody what a GSC is. They may not know what that
Oh, I'm sorry.
I know the realtors will know who HUD is, but they may not know what a GSE is.
That's government-sponsored entity. That's Fannie Mae and Freddie Mac.
Thank you.
And if a loan, a conventional loan, typically is bought by Fannie Mae and Freddie Mac, but now, you know, they don't want them to be on forbearance. That could be an issue. We know that Ginnie Mae has stated that. So it's making the secondary market very difficult. But we have a question about the credit bureau part, right?
Right.
Because I was trying to answer questions on the side. That's also a big unknown, because although servicers are mandated, and really would do so anyway, to not report negative information, that doesn't change that on the transactional history of the loan, the payments have been applied delinquent when we get them, right? So we can withhold negative reporting, but we can't solve to the fact that these payments truly were applied late if during the underwriting process, somebody has to look at that activity. So, you know, with the first payment defaults and how this will truly affect credit, a lot of that's up in the air. But there are independent, well, there's separate work streams going on at the national level. You know, the CFPB, who does have a lot of power over the credit bureau, the credit bureaus themselves, there's a lot of work going on there, because it's not just about the house, it's about the car, it's about the utilities, it's about the credit cards, it's about all the things that people are unable to pay because they're impacted by the COVID crisis. And a lot of things are being looked at and assessed, such that how do we keep America in a good position, because we're so dependent on credit scores. So a lot of that I think we'll be hearing about in the coming weeks.
Hi, so Jim Paulson, thanks for your question. So his question is, Angela, what does that mean to the consumer? Let's say they'll chase a wholesale line, or really, we don't know if the other wholesale lines are going to follow suit with what happened at 11 o'clock last night. And again, we understand what you're saying. It impacts the lenders, but what does it mean for my client?
Well, it means that, you know, banks can stay afloat. You know, they give themselves their own lines, right? So they have money. But for independent mortgage companies, that means it's harder to get money, right? That's what it means. It's harder to make loans. And for small brokers and for smaller independent mortgage companies, if they can't get those warehouse lines, because they can't get the loans off of their warehouse lines because they can't sell it on the secondary market, it means there's less money in the market to make loans.
And Angela, you're breaking up a little bit. So the other thing I want to tell everybody, Fairway, we do service. We haven't done a ton of servicing, have we, Kim? But we are starting, we have about 4.2 billion in servicing right now. And we are going to be starting to service some of our own loans. So that will help with what Angela was just referring to. So again, another reason to use Fairway, another reason to use your loan officer. Because again, what Angela just referred to, even though it says Kim Yao, I am not Kevin McGovern again. It's one of, maybe I should change my name to Kevin. Anyway, so I just want to make sure that you guys understand this as you're going out. And I know many of you are so loyal, and I know we have to give out the 3 business cards. I'm just asking you to give Fairway first for so many reasons. This is one of them. Servicing, right, Kim? So, right.
So, typically, Sarah, we only retain 2% of the production that we generate. But because of this environment right now, we do better in the market if we retain that servicing right now. So most of the conventional loans that are being closed right now will be retained by servicing, by Fairway. And what that means, we have a subservicer, but they will service in the name of Fairway. And actually what's really unique about our subservicing arrangement is that Fairway people in Carrollton, Texas will be performing the customer service and talking to the customers on the phone. So we're real pleased about that because we feel like Fairway gives an exceptional level of customer service.
And I want to clarify something too, if I can, as far as, banks, I say they have, they're better positioned as far as warehouse lines, but we're Fairway, being as large as we are and having as many relationships as we do with banks, and being that we can be much, as a private company, we can be much more nimble and much more responsive to the market, which is why that makes us a good option.
We've got some more questions. So here's another one from Marcia Collins. Welcome, Marcia. We're glad you're on the call. To clarify, why can't payment issues be resolved with a letter of explanation?
What type of payment issues? I'm not sure that I understand that question.
I think what she's asking, Kim, here is if they put their loan into forbearance, would have, a letter explaining I went into forbearance, would that solve it? I mean,
the credit bureau reporting issue?
Well, if they're going to get a refinance or they're going to buy another home and they went into forbearance and they write a letter to the lender that I went into forbearance, I don't know that that's going to solve it, but you can speak to that.
Basically, we're going to generate a payoff quote when it's time to pay off their loan. And it's going to reflect the interest due since the last paid installment. So if they haven't made a payment for 90 days, it's going to show 90 days of interest that is due.
So we have a ton of realtors on, and I'm so glad you guys are all here. And we have to remember that we just can't use lender lingo, because not like you guys probably have realtor lingo and we don't always necessarily know what you mean. Here's from Joe Gabriel. For us realtors, could you please dumb down for us wholesale lines and secondary? What does that mean?
You want to take that, Angela?
Sure. I think that's like the warehouse lines. What a warehouse line is banks loan money to mortgage companies so they can make loans. And soon as you close the loan, they're paid back. Sell your loan onto the secondary marketing and on the secondary market. And the secondary market is the Fannie, the Freddie, the Ginnie. So that you get your loan out there and you get paid a premium for selling the loan. And then you get servicing income if you retain the servicing. So that's just the way we churn the business so that we can have more money to make more loans. I don't know if that made sense.
Yeah, that's great. So we have so many questions coming over, but I want to go back. Don't worry, Daniela, we're going to go back to this beautiful graph with these beautiful pictures on this waterfall. So Kim, I'm going to go back to you on the,
Okay.
when everybody wants to keep moving through it. And if you can just,
Okay.
I'm going to try to kind of consolidate. And I don't know, Dewana, if you can get into the questions like you helped me and Kim with last time and consolidate some of these questions, because I love it. I love it that you're all asking all these questions. And we'll do another one of these. If this has been helpful for you today, we'll go to Forbearance 2.0, because I can guarantee you by next week, it'll change some more. Go ahead, Kim.
Okay, so we are at the repayment plan. So if they're able to get on a repayment plan and continuing to make their monthly payments and basically pay back that arrearage over the next year, at the end of that repayment plan, we're all good, we're done, check the box. Their account is current and they go back to normal servicing. But this, again, this is the waterfall flowing down. Let's say they can make their payment now, but they can't go on a payment plan because they have no additional funds. They can't pay me $1,250 a month or $1,500 a month. They can only pay the $1,000 a month. So then we would try to qualify them for a deferment or an FHA partial claim. So this is where it's a little different. If it's a Fannie or Freddie loan and they're only 2 months down, we can qualify them for a deferment, which basically means it becomes like a little balloon. It gets tagged on to the end of the note, and when the loan gets paid in full, they would pay it off at that time. It's not an extension, it's just when the loan gets paid off, it's paid in full. The FHA, and that's only for FHA loans, not VA loans, not USDA loans, but the FHA partial claim works similarly to that, except for it can go up to 12 months of delinquent payments. So, and basically what happens there is at that time, the customer is signing a separate promissory note to HUD. And then when they pay off their loan 5 years later, 10 years later, whenever it is, they then owe that balance that was capitalized or just tagged on to the end of their loan, if you will. It's a non-interest bearing note, but it's between them and HUD. But again, when they pay off, they have to pay it off. So in both of those examples, I want to make sure everybody understands the deferment or the FHA partial claim. It's really just how to deal with that amount of money that I didn't pay while I was in forbearance. I'm making my regular monthly mortgage payments now, and I'm trying to figure out what to do with that. $3,000 if it was 3 months, or $6,000 if it was 6 months. I've got that balance I can't take care of. Now, there'll be some that cannot qualify for the deferment or the FHA partial claim. So we're continuing in the waterfall. If they can't, then they would be considered for a loan modification. And this is truly a modification of the terms of the original note and the interest rate and the UPB and the payment and the term. So we basically are looking, it's a full underwriting review going on here. We're looking at their current financial situation, looking at the total arrearage. Most likely that arrearage, that total amount, will be capitalized and put into a new note. And Dewana, is there anything that you would like to add about a modification to help them understand that?
Really just that every agency and or investor will basically outline what requirements the customer needs to, what eligibility requirements the customer must meet to qualify for a modification. So it's important to keep in mind that based on investor or agency, the qualifications or the eligibility requirements may differ. So it's very important that if the customer is not able to reinstate post-forbearance, that they really engage with their servicer to understand what the eligibility requirements are for these programs post-forbearance.
So Dewana, we have one of those questions going on right now from Autumn Clifford. Welcome, Autumn. We're glad you're on. So is asking, a client of mine has their mortgage with Wells Fargo. They sent me a screenshot of the letter from Wells that says they can apply for payment assistance, and after the 3 months, if they're not able to pay the 3 months, then they can put the 3 months they missed to the end of the loan. My clients want to know if there's anything they should be concerned about.
Well, without knowing a lot about the type of loan, whether it's an FHA or a conventional, without having those specifics, it would be hard for me to kind of opine on that. But I would say that at the end of the forbearance, to reiterate Kim's point, it's very important to understand the amount is not forgiven. And it's not automatically tacked on to the end of the loan. The customer has to work with their servicer to determine what those next steps are. And so I hope that answers the question, but it's not automatic. It doesn't occur once the forbearance ends. The customer would really have to engage with Wells on what the next steps are.
We're also getting asked from Guy, welcome Guy, can they pay off the lump sum early?
When they pay
Yes,
off the loan,
absolutely.
yeah.
Yeah,
So at the end of the
they'll all
forbearance,
take the money early, no problem.
yeah.
Yeah.
At any
Yeah.
time, at any time during the forbearance, if the customer is able to reinstate, we strongly encourage them to do so. Typically what happens on the forbearance is the servicer will commence outbound outreach with the customer at least 30 days prior to the expiration of the forbearance. And so that's really just to gauge whether or not the hardship has been remediated and do they have the ability at that time to either remit a reduced payment or full payment or a full reinstatement in some cases.
So we'd like to make sure that everybody understands the servicer is there to keep the customer in their home and to help and to provide assistance. But we have to follow investor and agency guidelines. And this is just an overview. This is much more complicated. This is a high level overview. We just kind of show the understanding and kind of the waterfall. Servicers are going to start with a forbearance. At the end of the forbearance, we're going to try to reinstate you. If not, we're going to try to put you on a repayment plan. If not, we're going to set up a deferment or an FHA partial claim. And as a last resort, a modification. You know, unfortunately, if a customer is not eligible for a modification at that time, then we also have loss mitigation liquidation alternatives where the customer loses their home, which could include a short sale, a deed in lieu of foreclosure, or a foreclosure. But this can be very serious because once customers stop making their payments, you know, oftentimes it does result in situations that cannot be resolved.
So we're also being asked, again, what are you seeing, Kim, Angela, and Dewana, as far as the differential between Fannie, Freddie, GSEs? We learned that from Angela. Thank you, Angela. The other GSE, there'll be a test later, and also you'll win a prize. We love contests around here. What's happening with the government loans with Jenny?
Well, Jenny May actually, I mean, the thing is, everybody that you just mentioned, what they're all collectively trying to do is comply with the CARES Act, which was put in place to help consumers with every facet of any impact from the COVID crisis. And so everything we're seeing come out is really, everybody is trying to comply with the letter of the law, basically. The only real difference that I see that's material is that FHA offers that partial claim. That's the real material difference. There's the 2-payment deferral with the GSEs, but otherwise, to me, the big difference is the FHA because that can go 12 months of delinquencies can be wrapped up into that partial claim.
So here's a couple more questions for you guys. What is the date of the start of the COVID event according to the CARES Act?
Was that March 18th? I'll have to look that up.
March 18th, I think.
I got it.
I think we're day 25 on the printer. Okay, so here's another one. Is the lien that Kim mentioned, is this the same as the secretary lien for FHA loans?
Yes, that is
Yes.
what David Stevens is referring to as the secretary's lien is the FHA partial claim. The FHA partial claim has been out there in the past. It's kind of been resurrected for this.
Okay.
We believe the secretaries is because it's the secretary of HUD, maybe that's why it's called a secretary's lien.
Here's another one from Ann. Hi, Ann. Does it say on their mortgage statement what type of loan is it? If it's FHA conventional?
I'm trying to picture it on a mortgage statement. I don't believe that it
I
does.
don't think so.
But your servicer can provide you with that information, because I've seen other questions too. Your servicer can tell you if you have an FHA or you have a conventional that's insured. Your servicer can tell you who owns that loan, who owns the loan. So your servicer can provide you with all of that information. And generally servicers have self-serve websites, and all of that information is also available on the website if you register and log on.
So that's a good point. Servicers are overwhelmed with call volume right now. We've heard that at times some of the big banks have had 3,000 customers in queue. We know that some customers are holding 30 minutes and an hour, and they're doing callbacks. And customers need to get in line. They need to agree to the callback. They really need to talk to their servicers, but they can go into their portals. They can look online, and there's a lot of self-serve features for customers that they should take advantage of.
All right, so we're gonna wrap it up here, Kim, in about 5 minutes. Is there any questions? Is there anything that you think we missed just on the basics? Again, for the realtors, forbearance is not forgiveness. It's just buying time. There is a detrimental effect potentially if they want to refinance or they're trying to go into a new home. If people can make their payments, we're telling people, make your payment. Just make
Yes.
Absolutely.
Yes.
right. And then
Right.
also to get with their servicer before you try to advise them on this. The other thing, everybody's asking, these slides will go out to your loan officers so that they can forward them on to you. I would also highly suggest you do a Zoom call with your clientele, have your loan officer on there, and of course, always, we're here to help. And the servicing department, they've been on many calls with different town hall meetings with our customers to at least help them get their arms around it, because initially when the CARE Act came out, there was a lot of misinformation, and I think people just thought it was, oh, free pass, no problem. They didn't really understand what was coming behind it regarding what was going to be due, how this was going to affect them, and what it meant down the road. Because you don't get away from that payment, it just layers up for more money that you owe later, correct?
That's right. That's
Right.
correct. Yeah.
That is
All right.
correct.
Anything else that I missed out there for last question, throw it into, let me just see here if there's anything. And then we do have a winner on the strangest food. You realtors, you just are not good eaters either. Let's a lot of drinkers too, which we've had that with a lot of our loan officers. They're like, well, I had vodka and kombucha this morning for breakfast.
Wow.
Love it. So let me call out to our winner, which was, let me make sure I get this right. Is it Marcia? And Marcia's been eating peanut butter and tomato sandwiches.
Oh.
Not sure about that. So Marcia, if you could please get with your loan officer. We've got a gift certificate for you from Target. And then just one more, throwing it out. If you have a question in the chat room, wait, we got one popping up. Yes, thank you, Shannon. So Shannon's throwing out, forbearance should be used as a last resort.
Forbearance should be used by those customers that really need it. It should not be looked at as an opportunity or a missed opportunity or anything like that. It's there because there are customers that will really need it. They will need that time to recover from this because of loss.
Yeah, so I want to thank everybody for joining in today. What I want to tell you is we're going to be doing these town hall meetings every single week on a different topic to help you realtors, officers will be inviting you to these things. It's Mary Satansky Pagel. So Mary, I think I was just doing the Brady Bunch flashback with all this Zoom going on. Marsha. Anyway, Mary, get with your loan officer. We'll make sure and get you a gift certificate. So sorry about calling you Marsha. You can call me Sharon from here forth. All right. Or Kevin. Kevin would be good too. All right. Thanks, everybody. Have a great Easter. Just really, really cherish your family. Take this time to take care of yourself and breathe deep. We will all be released into the wild here soon. Everyone have a great afternoon.
Thanks, Sarah.
Thank you guys so much. You ladies are amazing.
You're welcome. Thank
you.
you.
Bye.
Bye.